Is the hottest semiconductor stock on the market flashing a strong buy signal, or is it actually just a cleverly disguised trap?
Oh, that's the big question right now.
Right. I mean, with massive gains on one hand and these loud warnings of a cyclical peak on the other, are we looking at an undervalued gem, or is this a disaster waiting to happen?
Yeah, especially when the underlying asset isn't even behaving like a traditional stock anymore. It's
Right.
um it's acting more like a speculative singularity right now.
Exactly. So, welcome to the deep dive. Our mission today is to tear apart the mechanics and just the pure momentum of the Direxion Daily Semiconductor Bull 3X ETF.
Ticker symbol SOXL.
Right, SOXL. And we're looking at a data snapshot from April 14th, 2026, which is just extreme in almost every mechanism we track.
It really is.
And real quick housekeeping, if you're listening to this, do us a favor, like the video, subscribe to our YouTube channel, and it's practically compulsory that you leave your feedback in the comments. We want to know what you think.
We definitely read them.
We do. Also, just so we are totally clear up front, we are here to unpack the raw data today. The structure of this asset, the market psychology. This is purely an analysis of the data and a natural debate.
Yeah, absolutely no financial advice here.
Zero.
None at all.
Which is an important disclaimer because the second you step into the world of 3x leveraged ETFs, traditional investing rules, they're basically suspended. You're in a totally different universe of risk.
I found that out immediately. Like, my first move when evaluating an asset is usually to rip into the fundamentals. I'm looking for the quarterly income statement, the balance, cash flow.
Right, the standard stuff.
Exactly.
So,
But applying that to SOXL yielded absolutely nothing. Like, there are no corporate revenue numbers, no profit margins.
oh, yeah, because you can't find an income statement for something that isn't a traditional corporation.
Wait, what do you mean?
I mean, SOXL doesn't make silicon wafers, it doesn't have a sales team. It's
Yeah.
just a financial instrument. It's a wrapper. Okay, so if it's a wrapper, what's actually inside it? Because I assume it's not just a vault full of Nvidia and AMD stock certificates.
No, not at all. Inside that wrapper is this incredibly complex web of financial derivatives, mainly total return swaps that they negotiate with major investment banks.
Okay, total return swaps.
Right. Because the stated goal of SOXL is to deliver 3 times the daily performance of the ICE Semiconductor Index.
3 times the daily performance, just to emphasize that.
Exactly. So to get that daily 3x multiplier, the fund managers aren't just buying shares on margin, they're entering into synthetic contracts. Your money is basically funding a math formula that resets every single day at the closing bell.
Oh, wow. So the health of the asset isn't about corporate profit at all.
No, it's measured strictly by its net asset value, or NAV,
Yeah.
and the liquidity of those underlying swap agreements.
That actually makes the recent price action even more staggering. We aren't looking at a company curing a disease. We're looking at a math equation that's acting like a black hole for market liquidity.
A very aggressive black hole.
Right. Let's look at the numbers from the April 14 close. SOXL was trading at $85.31. That is a 5.9% jump in a single day.
Which is wild.
But the velocity over the past 2 weeks is what really caught my eye. It is up 72.84% in just 14 days.
The sheer angle of that ascent is just historic. But to really understand the gravity of $85, you have to contextualize it against the last 12 months.
Okay, let's zoom out.
Because just yesterday, it printed a fresh 52-week high of $86.18.
Yeah.
Now, rewind the tape to April 21, 2025.
A year ago.
Right. The 52-week low for this exact same mathematical formula was $8.15.
$8. Wow. So a tenfold growth in less than a year, $8 to $86.
Exactly.
I mean, that kind of parabolic momentum doesn't just attract regular investors. It attracts like momentum algorithms and heavy retail FOMO. People see that and panic buy.
And the inflows prove that exact thesis. The money chasing this momentum is blinding right now. Over just a recent 5-day period, the fund saw net inflows of $328.09 million.
Wait, $328 million in 5 days.
Yep. $1/3 billion of fresh capital flooding into a highly specialized derivative product in 1 week.
That's insane. And that pushes the total assets under management up to what, roughly $13.34 billion?
Around there, yeah. It's a massive footprint.
But holding this isn't free, right? Our data highlights an expense ratio of 0.75%.
Which is high.
Yeah, in the world of passive ETFs, where you might pay like 0.03% for an S&P tracker, 0.75 is astronomical.
Well, there's a cost to manufacturing all that leverage. The derivatives carry counterparty risk, premium costs, and all of that acts as a constant drag on the NAV.
I see. And the dividend yield is practically non-existent, what,
Yeah.
0.05 to 0.28%?
Yeah, it's negligible.
Yeah.
But let's be real. Nobody is parking their money in a 3x leveraged ETF for 0.25% annual dividend.
Obviously not. They're here for the violence of the price action. They're here for that 72% two-week gain, which means we really need to look under the hood at the technicals.
Let's do it.
Because if we have $328 million chasing a daily swap contract, that has to be warping the chart.
It is warping it aggressively.
Yeah.
I mean, we're looking at 9 consecutive days of price increases, 9 straight sessions of green candles.
Wow.
And when we pull up the moving averages, you see a total detachment from historical norms. The 5-day moving average is trailing at $84.05.
Okay.
The 50-day is way down at $68.88. And the 200-day long-term trend line is stranded all the way down at $56.39.
So the current price is sitting almost $30 above its 200-day average. It hasn't just broken out. It's like severed the tether completely.
Completely severed.
But I want to challenge something here because analysts at investing.com are kind of screaming about the RSI right now, the relative strength index.
Right, the RSI. What's fascinating here is where it's sitting.
Exactly. They note it's at 83.41. And traditional mechanics say anything over 70 is overbought, so 83 is critically overextended. But, and here's my question, in a true AI supercycle, doesn't RSI become almost meaningless?
It's a fair pushback.
Because we've seen assets stay pinned above 80 for months during historic runs, if the macro demand for semiconductors is insatiable, why should we fear an 83 RSI today?
Like I said, fair point. Momentum can definitely remain irrational longer than shorts can remain solvent. An RSI of 83 doesn't guarantee a crash tomorrow morning.
Right.
However, you have to remember what RSI measures. It's internal momentum.
Yeah.
At 83.41, it tells us the buying pressure has been so relentless, so one-sided, that the market has basically exhausted its immediate pool of marginal buyers.
Okay. Everybody who wants in is already in.
Exactly. Combine that with short-term weakness signals and elasticity that's stretched to its absolute physical limit.
I see the vulnerability there, especially when we look at the volume data, because the fund traded 61.6 million shares in the latest session, which is massive liquidity.
It is.
But interestingly, that volume was slightly lower than the day before, even as the price went up. So price rising on decreasing volume, isn't that a classic divergence?
Yeah, it implies the rally is gasping for air. It's like a sports car redlining in 6th gear, but the engine is getting exhausted.
Oh, I like that analogy. So if the engine is exhausted, let's map out the support and resistance zones. The ceiling seems obvious, that 52-week high of $86.18.
Right. If the bulls smash through that with high volume, it's blue sky territory. No historical resistance above it.
But what about the floor?
The floor is where the structural integrity really comes into question. Immediate support sits at $80.71.
Okay, so a drop to 80.71. But what happens if that fails? If algorithmic buying flips to algorithmic selling, where's the next concrete floor?
Well, based on historical volume nodes, if it breaks 80, there is practically no structural support until it hits $49.65.
Wait, $49? Are you saying there is a $30 air pocket beneath the current price?
I am.
That's not a minor pullback. That's a trap door. That's like standing on the 85th floor of a skyscraper, but floors 50 through 80 are just empty elevator shafts.
Exactly. If the 80th floor buckles, you're in free fall. And that is the precise danger of a parabolic low-volume melt-up.
Because it moved from 50 to 85 so quickly that no foundational base was ever built.
Right. Nobody accumulated shares in the 60s or 70s to act as a buffer.
Which brings us to the core debate right now. Analysts have a consensus strong buy on this, even though they expect a minor 1 or 2 day cooling off period. But looking at that $30 trapdoor, is SOXL actually an undervalued proxy for AI, or is this the ultimate value trap for retail investors?
Calling a 3x daily resetting ETF undervalued shows a fundamental misunderstanding of what it is. Traditional intrinsic value just does not apply to a synthetic swap derivative.
So you can't just buy and hold it like a value stock?
No. It is a momentum vehicle engineered for short-term volatility. When everyday retail traders treat it like a long-term value play, when they buy at 85 and plan to hold it in their retirement account for 5 years, they are stepping directly into a trap.
Because they assume 3x leverage just means their portfolio will grow 3 times faster than the S&P over the next decade.
Right. And that assumption totally ignores the brutal mathematical reality of leverage decay or, volatility drag. This is the mechanism that actively destroys long-term wealth in these funds.
Okay, let's actually walk through the mechanics of that decay. I want to do the math for the listener because understanding this is literally the difference between using a tool and getting dismantled by it. How does that work?
Let's use a simplified baseline. Imagine the underlying semiconductor index is at 100 points,
Okay.
and your SOXL investment is worth $100.
Oh.
Over the course of a bad week, the underlying index drops by 10%. It falls from 100 down to 90.
Right.
Because SOXL is 3x leveraged, it doesn't drop 10%, it drops 30%. Your investment goes from $100 down to $70.
Ouch. Okay, painful week, but markets usually recover.
They do. So the next week, the underlying index rallies. To get from 90 back to 100, it needs to gain roughly 11.1%.
Okay.
So the index is fully recovered. It's flat over the 2 weeks. Now, look at SOXL. It gets 3x that 11.1% recovery, which is a massive 33.3% gain.
Which sounds amazing.
It does, until you apply that 33.3% gain to your depleted $70 balance. 33% of 70 is roughly 23 bucks. Add that back, and you were sitting at $93.
Wait.
Yep. The underlying market went through a dip, fully recovered, and is exactly where it started. But because of daily compounding math, you have permanently lost 7% of your capital.
You literally walked up a down escalator. The
Yeah.
volatility itself chewed up the capital, and that was just a standard 10% correction.
Exactly. If the underlying index hits a 20% bear market, the 3x leveraged fund requires a mathematical miracle just to break even. It's so corrosive.
So it's really a surgical scalpel for day traders, not a buy and hold asset.
Right. It's meant to capitalize on clear multi-day trends. It is not designed to sit in a portfolio for years.
Okay, I hear the decay argument. The math is undeniable. But let me advocate for the bulls here for a second because the money is still flowing in.
Sure, let's hear it.
If I bought SOXL at that $8 low a year ago, I'm sitting on a 10x gain today. The leverage decay didn't destroy my capital because the parabolic momentum completely outran the decay.
In a straight lineup, leverage compounds in your favor. That's true.
And the bull case is entirely predicated on this straight line continuing because of the AI supercycle.
The AI infrastructure thesis.
Yeah. Bulls argue we are in the earliest innings of a global computing overhaul. Megacap tech, enterprise data centers, they're all in an arms race for high-end GPUs. It's not just training large language models anymore, it's inference compute.
Right, the chips needed every time AI generates an image.
Exactly. And the top holdings of the underlying index, giants like Nvidia and AMD, are reporting demand that outstrips supply for years. So the bulls look at that, and they conclude that stepping in front of this freight train just because of a high RSI is financial suicide.
Look, the AI thesis is structurally sound. The demand is very real. But the bear case doesn't dispute the existence of AI.
What does it dispute?
The mechanics of the semiconductor industry itself. We have to look at cycle analysis. Historically, semiconductors are the most notoriously cyclical industry on the planet.
The classic boom and bust.
Precisely. It's driven by the bullwhip effect. Right now, because of the AI gold rush, companies are terrified of chip shortages. So they double or triple order. They hoard GPUs.
All right, panic buying.
And the foundries see this astronomical demand and spend tens of billions building new fabrication plants to increase capacity.
But eventually, that capacity comes online.
And when it does, the initial panic buying has subsided. Suddenly, foundries are overproducing, tech companies have massive inventory gluts, and they stop ordering. Prices get slashed, margins collapse, and the sector violently corrects.
And our source material actually highlights some major red flags from historical cycle analysts regarding this exact phenomenon.
Yes, they are projecting that the sector may be approaching a massive cyclical peak, potentially starting in mid-2026.
And since our data snapshot is mid-April 2026, they're basically calling a top right now.
Right, and we have to respect the historical precedents of those cycle tops. During previous busts, standard unleveraged chip stocks routinely suffered 50 to 60% drawdowns.
So if the underlying index drops 50%, what happens to a daily resetting 3x leveraged ETF?
Total devastation. In past cycles, assets structured like SOXL have experienced drawdowns exceeding 90%.
A 90% wipeout. So if you buy at the $86 top and try to hold through a cyclical winter, your capital is effectively vaporized.
Because that leverage decay we discussed, it actually accelerates the downward spiral. When the index drops, SOXL plummets. When the index tries to bounce, SOXL has too small of a capital base to recover. just compounds itself into the ground.
Wow. Okay, so we are looking at an asset sitting right at the intersection of technological euphoria and extreme structural risk.
That's the perfect way to put it.
Let's synthesize this for you, the listener, trying to navigate all this data. SOXL right now is a high-octane mirror reflecting peak market greed. It's offering breathtaking short-term momentum. 9 straight days of gains, a 72% run in 2 weeks.
But beneath that momentum, the structural floor is incredibly fragile. We have a massive volume air pocket down to $49 and an asset entirely dependent on synthetic derivatives that actively decay in volatile markets.
It is an instrument of precision. If you don't understand the daily rebalancing math, or if you ignore the looming threat of the semiconductor bullwhip effect, this asset will absolutely trap you.
Which leaves us with a final, unavoidable question.
Right.
The cycle analysts are pointing to historical data warning that a massive, potentially 90% cyclical correction is slated for mid-2026. And we are currently sitting at an all-time 52-week high in mid-April 2026, with technical indicators stretched to the absolute breaking point.
So when you look at that $85 price tag, you have to ask yourself, are you looking at the explosive beginning of a new permanent AI paradigm? Or are you standing at the very edge of the cliff? That is something you have to answer for yourself before you step into the arena.
Always question the consensus.
Yes, exactly. Thank you for joining us on this deep dive. Leave your thoughts in the comments, mind the leverage trap, and we'll catch you next time.